And if you really look at the incentive of the IRS, the incentive is to tax you, right? I always tell people the IRS is the best Guido in the United States, right? They're going to come after you. They're going to get their taxes. That's their job. That's just the nature of it. Regardless if you want them to or not, it's just the way that the system works. And so if you look at it from their lens and say, okay, why would I ever let Dan transfer his valuable home to his daughter? And I never, and at let's say he sells it for $1. Well, the problem is that in that IRS, that's a huge loss. Welcome to Critical Thinking Required, hosted by LBW. This podcast is intended for free thinkers, entrepreneurs, and knowledge seekers. Join us as we discuss relevant financial topics, explore with guests their financial journeys, and engage with experts in industries such as space, media and entertainment, real estate, and many more. Buckle up and enjoy the ride. Welcome to Critical Thinking Required. Here with your hosts, myself, Tim Bickmore, and my colleague, Dan Weiss. We are missing the third musketeer, Nathaniel Leach, today, but that's okay because I think Dan's going to lead us on this journey in what we're going to call the art of giving. And what we're going to talk about today is we're going to talk about giving money, both on the personal side and business, because we interact with a lot of people who are charitable and like to give to family members and others. And sometimes people just don't understand the rules and how that really works. So we want to just shed some light on it today, especially because it is the giving season. We have Hanukkah, Christmas, a bunch of holidays coming up, the New Year. So we want to talk about that and move forward. But before we jump into our conversation, I let Dan take over. As always, if you enjoy our content, what would really, really help us is if you could please share, subscribe, and like our content. Dan, can you start us off with the art of giving?
Before we get into methods and the reasons for those methods and the complications, we should probably talk about first just a couple set of rules. So, and I can state this and Tim can kind of jump into, it's actually fairly concrete. Well, it's very concrete. So you have every single year an amount that an individual can gift to another individual, any beneficiary. We'll give some examples. And so every year you can gift this without incurring any taxation or issues that get really applied to your lifetime exemption limits, which we'll talk about as well too. Anything above these amounts, you have to file what is called a gift tax return. So just draw a line in the sand. And if you want to make it easy, clear, and not have any issues, give up to this amount or less. In 2021, where we stand today, that amount is $15,000 a year per a beneficiary. And in 2022, that will go up to $16,000. So an example, I'm going to hit on this and it's going to lead really well into the lifetime exemption limits, which Tim could fix, add, correct, whatever be the case, anything I've just said, and then jump into this piece. To give you an example, let's say that you want to give to a brother, parent, sister, child, whatever be the case. You can do $15,000 to each one of those people without having to worry about filing a gift tax return. And if you are a married individual, you can give or receive also that $15,000. So, well, where we might see this sometimes is, let's say that you are looking to buy a home and you need a little bit more down payment than what you have. If you have parents that have the capacity and generosity to give you funds, and both your parents are alive, you could receive $15,000 from one parent, $15,000 from the other parent. Let's say you are married, then you can then have them do the same for that spouse, for a total of $60,000 of gifts that fall underneath this gift tax concept. Tim, anything else you want to add to what the capacity is for people to give to another individual annually?
No, I think the only thing I'd add to you did a great job, Dan. is if you are married, you technically, as Dan kind of mentioned, so if you have you and your spouse, you have the ability to give $15,000 each. So again, that total of $30,000. And that is something that you can do, or you can do it separately as well. If you're to go above that, there's what's called like a married filing jointly gift tax return. But yeah, outside of that, it's just knowing that you can double it up, give it to the child, and it is per individual. And it could be anybody, really. It could be a neighbor, it could be family member, can really be anyone that you're looking to give money to, and the IRS will just say, great, that's good. In addition, so there's a donor, the donee who's receiving the cash, that is not considered income. So they're not going to be taxed on that as well.
Great. Thank you, Tim. Do you want to actually touch maybe on lifetime exemption limits as well?
Sure. So as Dan kind of alluded to, there is what's called the lifetime exclusion limit. And so what the IRS is doing there is they're saying, okay, citizens of the United States, we will allow you to gift up to a certain amount of money over your lifetime. So that could be at the date of your death. That could be during your life as you're living. It just depends. A lot of people will typically try to use that for at the date of death. It is transferable to a spouse. So for example, the limits there for 2021 was about 11.7 million per individual. So the total would be roughly almost 23 to 24 million dollars for a household for spouses, because you can transfer that over directly to the spouse at your death. Going into 2022, that amount's moving up to 12 million, a little over $12 million per individual. Now, there has been legislation that has come out this year, or proposed legislation, to change that lifetime exclusion amount. But there is there is that going on currently. So, but it's still ongoing. It hasn't been solidified yet. What you can essentially do is you can gift. So if you were to, for example, give, and let's say you and your spouse decide you want to give $30,000 to your only child, and instead of giving 30,000, you want to give them 100,000. So simple math, that's $70,000 over the annual exclusion limit that you can gift. That wouldn't be technically taxed. Now, if you didn't want to be taxed on that money that you gave to the donee, because the donee wouldn't be taxed, the individual who is giving the money would, the donor, then you could file a gift tax return underneath your lifetime exclusion limit, which would then take away from that 11.7 million in 2021, or a little over 12 million in 2022. And then at your date of death, that means your overall exclusion limit would come down. Now, those limits are really, really high, and it's not a bad idea if you're willing to do it. That you have to make sure you understand your own net worth, where your projections are, where you think you need to use it or not use it. But the other caveat to that is an ongoing conversation in the federal government. So both Republicans and Democrats have both raised it and decreased it over time in different ways. And there's even been talks at one point to completely get rid of it, so you could gift any amount of money at any point. So the reason why I bring that up is sometimes it's very difficult for estate planning lawyers to plan around that, because it does change. And right now there is it is a hot topic. It's in the hot seat from a regulation standpoint. And so you also have to take that into consideration, because, early 2000s, I believe the limit was somewhere around like $1 million to $2 million per person. And so now it's a lot more significant. So it does change. It does fluctuate. The legislation is proposed going forward into 2022. It was proposed to bring it back down to, I believe, around 6 to 7 million, or even as low as 3 million, I believe. That's been a lot of talks around what it would come down to. So the reason is that if you start dipping into your exclusion limit, 11.7 million sounds like a lot now, but that can adjust in the potential future. So it's just something to think about. I think I hit everything on that, Dan.
That's a really nice cap, Tim. I think you said that really well. I'm glad that you pointed out that every year it's always going to be an ongoing conversation, that those limits can indeed change. Tim mentioned it has been in recent years, if you want to call the early 2000s recent. I think they're still recent. is low is a million. It's actually been lower than that too. And in like the late 90s all the way up until 2001, it ranged in the 600s. So, 2001, it was like $675,000. So that's a long way away from where it has been in the past and
Well,
now and current.
and yeah, and then even where it was even proposed to completely get rid of it, like completely
Mhm.
eliminate it all the way. So it's there's extreme sides on both angles of either lowering it to a low level or increasing it to essentially, gift as much as you want. I don't know that it will ever. I don't know. Actually, I can't even say that with confidence. It's just an ongoing topic that's pretty highly debated.
So be aware of what those limits are, especially if your state exceeds those lifetime exemption limits on the federal side. And actually, there in some states, Wisconsin not being one of them, but in a number of states, there's also a state limit. So you have to be aware of going over the federal limit, and you also have to be aware of going over the state limit. Like for example, I think just to the south of us in Illinois, I believe that limit is 4 million. So anything above that 4 million mark, you are seeing taxation, and that taxation can be quite a bit. I mean, it has been coined before is the death tax, and where you're looking at about a 40% tax. So something to keep in mind. Moving on to just some different transfer concepts. We're going to be all over the place on this, but here we're going to just mention a couple things that we see or don't see, but should see to be aware of. So starting out, I'll tackle I'll at least kind of throw out there. How about that? The first piece, which is when you give somebody a gift, it does not always have to be cash. And there are some benefits to consider. And there are also some complications if you gift things that are not in tax. So you can gift, for example, in kind, which means that you gift a property as a property, a security, a stock, right, as a stock, as opposed to selling it into cash and then gifting it. We see a lot of this individually. We see a lot of this from a charitable standpoint too. Tim, could you talk a little bit about why somebody may do this and what the benefits and cons are?
Here we go. Yeah, Dan, happy to talk about different transfers and talk about in-kind transfer specifically. To use a good example of an in-kind transfer, let's say that I hold Bitcoin and Dan is a good friend of mine and I want to give him a Bitcoin. So right now, Bitcoin, I think the price is somewhere around like $40,000 to $50,000 per coin. And so I want to gift that to him. But because of that price is a lot higher than the exclusion limit that I would be able to have, which is $15,000 I could give to Dan. But what I could go ahead and do is I could go ahead and gift that coin over to Dan and then either take it from my, use the $15,000 in the annual exclusion and then use my lifetime exemption to be able to do the rest. So there's no taxation on that. And maybe the reason why I do that is I really like Dan. Maybe I owed him some money or something. And I also have a large amount of embedded gains within that gift tax. And so I just want to defer it. So instead of turning it into cash, right, and incurring that taxation, I go ahead and I say, hey, Dan, here's my Bitcoin. One of the other reasons why I do it is I know that Dan is going to hold it for the long term. So him and I can both defer those gains over the long run. That is what could make sense for an in-kind transfer is when you have embedded gains, it allows, if that person isn't going to need it, right? Dan doesn't need the Bitcoin. I'm just giving it to him because he's my great friend. And I think that he's going to hold it for the long term. So he doesn't incur those taxable gains for a long time as well. Now, if you do that though, my cost basis, so whatever I bought the Bitcoin at, let's say I bought it at $1, I was one of those people, would then transfer to Dan. So at whatever point Dan decides to sell that, he would have to pay capital gains taxes on that proceed, on the difference between what he sold it for and what I bought it for. But overall, it just continues to allow us to defer those gains over the long run. Now, the con to that would be that I'm giving him a Bitcoin. I also have to take out my lifetime exclusion limit. And maybe Dan doesn't want the Bitcoin because Dan needs cash. So maybe it just makes more sense for me to donate cash to Dan, or not donate, give Dan cash instead of the Bitcoin because he actually needs to use it as a transaction. So if I were to give him that Bitcoin, then what would happen is he'd have to pay a lot of taxation on that Bitcoin. So if I instead had cash on hand, $50,000, it may make sense just to give it to him that way. A couple other things too is like maybe you don't have cash and the Bitcoin makes sense. Let's say it's not Bitcoin. Let's say it's stock, or let's say it's a car that I gift to Dan, right? Say, hey, Dan, you want my car? You don't have to pay me for it. It's worth $8,000. It's underneath the annual exclusion limit. I give him my car and transfer it that way. So there's just a lot of different ways that you can gift an asset to another individual. And it just depends on what you're looking to do and how to do it. When it comes to gifting, which we will talk about actually in stage 3 here in charity, but we'll talk about it later just to kind of allude to it. When you're giving to charities, it really matters, because appreciated assets, your deduction is different compared to cash, compared to a useful asset, right? Like a house is the deduction becomes different, which we won't go into the details on that, but I just want to let people know that there is something that you really have to pay attention to when gifting to specific charities of appreciated securities as well. Dan, I know you probably are groveling at me giving you a Bitcoin, but it was a good example.
I did like the example. We do occasionally, again, this is not the topic, but we do more than once have people interested in Bitcoin and trading Bitcoin because they feel like they won't be taxed. Alas, that is not true. You are still paying taxes on your Bitcoin gains, so that is no different than giving another security from that sense. Commonly the case too, we have encountered situations, particularly friends or family, that are looking for a loan, right? So a conversation that comes up often is, oh, I'm going to borrow money, or I'm going to give somebody money so they can do X, Y, and Z. And usually this is a good friend or a family member, and it's going to be an interest-free loan. Okay, well, we're here to tell you that you need to make sure if that's the case, that it's definitely under the table, because you can't just do that, at least not according to the IRS rules. And so I will turn it over to Tim and talk a little bit about why that is the case and what you have to consider.
We are always very excited when we have family members that are willing to give other family members money for a loan. And it always makes a lot of sense, because typically that family member's willing to give a loan at a lot lower interest rate than maybe a bank would allow for that person to get a loan. We see it a lot when children are getting houses and getting loans, like quote unquote loans or gifts from parents. We see it a lot sometimes where kids maybe give a loan to parents, right? And it really is a good way if you have the ability to, and you feel comfortable, both sides feel comfortable about the transaction. The problem is that people then just assume, hey, Dan needs $100,000 and I'm just going to give it to him and he's going to pay me back. But I'm not going to charge him any interest. Why would I charge Dan interest? He's one of my best friends. Like, I don't want to do that to him. The issue there is that the IRS is going to look at that as a gift. And that means it's going to dip into your exclusion amount, or if you don't do anything over that $15,000, then you're going to have to pay taxes on it, because it's not considered a loan. So in order to really create a loan, you really have to create a structure, like a note, a bond, a note, or really a note. And it has to be in form where you use what's called the applicable federal rate. And that is actually published by the IRS on a monthly basis on both a short, medium, and long-term basis. So you can go to those charts and you can start looking at what interest rates are currently being charged, and you should at least charge that amount. Now, lucky for everybody who's listening to this in today's day and age, the long-term rate on a note or on a loan would be anywhere from 1.08 up to 1.84%, depending on how it's compounded. So it's still dirt cheap, but you really should allow that person to be charged interest. So then it is considered debt. And the interest that the individual would be receiving, like, so if I gave Dan $100,000, I said, hey, Dan, you're my best friend. You need 100,000. I'm going to charge you 1.84%. Give it back to me. We structure it for, let's say 15 years. And then Dan and I have that agreement. The interest I receive would be considered taxable income. So that is just something of note, but you really do need to consider that. So when I know parents are typically like, I don't want to charge interest. It's not that we want you to charge your kid interest. It's more so to make sure that you aren't dipping into some of those lifetime exclusion amounts or getting across those gifting rules. So people just sometimes get confused that they can just give money to people at 0%, 0% interest. Unfortunately, the IRS just won't recognize that.
Speaking of IRS, speaking of family, another thing we commonly see is what's called an arm's length transaction. And where we most likely are to see this is, for example, is with an asset. For example, a parent wants to sell a home to their child, and they want the child to get a good price for this home. So they sell this home underneath market prices to give them that benefit. Or we've seen this many times over with vehicles. And Tim, this can sometimes create some issues with the IRS that people are unaware of, such as.
Yes. So, well, the way that the IRS is going to look at that transaction, and I think that for this whole conversation, you always have to think in the lens of the IRS, right? Whenever you have a tax question, like, why am I taxed on this? You have to perceive everything from the IRS lens. And if you really look at the incentive of the IRS, the incentive is to tax you, right? I always tell people the IRS is the best Guido in the United States, right? They're going to come after you. They're going to get their taxes. That's their job. That's just the nature of it. Regardless if you want them to or not, it's just the way that the system works. And so if you look at it from their lens and say, okay, why would I ever let Dan transfer his valuable home to his daughter? And I never, and at, let's say at zero, he sells it to her for $0, right? Hey, or $1. Let's not say zero. Let's say he sells it for $1. Well, the problem is that in that IRS, that's a huge loss. Now, Dan, if he was really crafty, may say, well, I'm going to take a loss on that because it's really worth $500,000 and I sold it for $1. Look, I have this huge tax write-off of $499,999. Now, that would obviously throw a huge red flag up to the IRS, and they'd probably come after Dan, and they'd say, no, Dan, that's not really appropriate. You really didn't sell it for that. You can't do that. And one of the reasonings behind that is they're going to say, Dan, that was not an arm's length transaction. And Dan's going to say, what in the hell is an arm's length transaction? And it's like, well, it's a transaction where it's not independent parties, right? You're related to this individual. You're related to your daughter, which means it looks like you're really evading taxes or avoiding taxes. And because of that, we're going to nullify that sell, and we're actually going to charge you on that income of the sell that you didn't pay your taxes on. And so that's typically what's going to happen. So when it comes to family members specifically or related parties, such as Dan and I as business partners, you have to be kind of conscious on how you work with it, because if you were to be audited with whatever transaction you're trying to do, they're going to scrutinize it even more, knowing that you know that person. And then you got to think, well, why would they do that? If you're looking from the IRS lens, well, it makes a ton of sense. You know each other. He knows Leora. I know Dan. We can be working on the side to avoid or evade taxes. And that's not the IRS's. They don't like that. They don't want to do that. They want to make sure that you do pay the taxes in an appropriate route. So it's something that you just have to be very conscious of. And I know sometimes it's not fun, but and in addition to, I'm just going to jump in, Dan, unless you have anything else to say on that, but into our next subject. So the other thing too is putting an asset in someone else's name. A lot of this times people will talk about that for a lot of different reasons. And we don't need to get into the reasons, but they'll say, hey, mom's house is in her name and we want to move it into the kid's name. It's going to pass to us anyways. Well, there's a couple things that you need to really think about that. Right now, via the IRS code, there's what's called a step up in cost basis, meaning that if that mother were to die at that date of death, the kids could step the cost of the home up to the value, whatever its value is at the time, removing any capital gains that they may receive. Once she passes, they could go ahead and sell that home and pay zero taxes on it. So to move that asset out of her name into the kids' names before that, what happens is unless they purchase it from her, creating a new cost basis, or let's say she gifts it to them, then what's going to happen is that cost basis of the donor goes to the donee. And now you no longer have the step up in basis at time of death. So there's a lot more to think about when you start transferring things in and out of people's names. The other thing too that we always stress is it's nice to gift things to people, but when you gift it, it's no longer yours. So it's almost as if you gave somebody on the street $20 and then you try to run them down and say, give me my $20 back. They're gonna be like, absolutely not. I'm gonna keep my $20. You gave it to me. And you're gonna be like, well, I'm gonna sue you for it. Well, no, you can't, because you gave it to me, and there is no legal ramifications. That's essentially what happens with any gifting. So if a mother or a parent is gifting their home to their children now own that home. And we always go worst case scenario. The children could kick the mother out of the home. No problem. Like that's not an issue. And we will say that there is a lot of elder abuse. You have to be very conscious of that. And we're very conscious of it when we always, or at least we look for it, because once you're in the ownership of that asset, it is now yours. It is no longer yours. There's no longer the person who used to have it. So it's just putting things in another person's name. There can be some benefits in it in a lot of different angles, but there's also a lot of cons. And so it's really a balance in understanding how that actually works, how the IRS is going to look at it, and if it makes sense for the situation at the time at hand. And that could even be giving it to an irrevocable trust. There's just a lot of different things that you could kind of look at that.
And do just want to stress too that if you are making a gift, and it's probably a pretty major gift, if you are putting into someone's name like a home or so, you have to be very, very conscious about how long you hold that gift. Where we often see this is a situation, right, where an older parent is or grandparent is gifting that asset, and they're doing so because they're worried about long-term care needs coming into play. And if you do that and those long-term care needs come into play, and that person who gifted you that money runs out of funds for that long-term care provider, like a nursing home, to go after, they're going to follow the money, and they're going to follow that money to you. And if you've held that asset for less than 5 years, they're going to come after you for that asset. And where we've seen this, unfortunately, go real south is when the receiver of that asset uses those funds up or for some other purpose, and now they have a liability with this third party from a collection standpoint. Moving into more of although some of these can definitely apply in a business and investment standpoint, but more commonly things that we see underneath that umbrella, starting with really, and this typically applies to business owner clients that we work with, where you're moving one asset to another asset, or another one entity, I should say, to another entity. And that is not so easy to do, right? And so we probably don't have too much to say on that. I'll say a piece, and Tim can jump in if he feels so inclined to do so.
Thank you for taking the time to start your journey of thinking differently and listening to LBW talk about stuff they love. Until next time.